Ever wonder what really moves the needle when it comes to building a profitable investment portfolio? Many of us are tempted to think it's about picking the next stock, like an Apple or a Tesla. But what if I told you the true secret behind robust investment success is something far less glamorous but way more dependable? According to Vanguard, one of the investment world's most trusted names, a whopping 90% of your investment returns are determined by just one thing: asset allocation. Today, I'm pulling back the curtain on this crucial yet often overlooked aspect of investing and break down what asset allocation actually is and how to execute it so you can feel much more confident with how you invest. All right, first things first, what on earth is asset allocation? Simply put, it's about where you put your money. Think of it like deciding how to use your monthly salary. Some of it might go into savings accounts, some might be used to pay down a mortgage, and maybe a portion gets invested in a side business. Now, let's think about it from an investing perspective. In its simplest form, asset allocation is the practice of dividing your investments among different asset classes like stocks, bonds, real estate, cash, and categories like currencies. Imagine your investment portfolio as a pie. Each slice of the pie represents a different type of asset. The size of each pie, that's what asset allocation is all about. And just like you wouldn't put all your monthly income into dining out and Netflix, you shouldn't put all your investment eggs in one basket either. The key to asset allocation is spreading your money around so it can focus on what you're looking to achieve, whether it is growth, income, or stability. Vanguard, the global investment powerhouse, conducted a study examining over 600 Australian balanced funds over a span of 25 years. This objective was to understand what truly drives the performance of an investment portfolio over the long term. And the key takeaway from this study: a remarkable 89.3% of a portfolio's long-term results were determined by asset allocation. In essence, where you put your money, like putting in the stock market, savings accounts, or properties, majorly influences your financial success over a long-term horizon. The concept of success here refers to achieving stable long-term returns on an investment portfolio. It's not about striking it rich quickly or beating the market every single quarter. It's about consistent performance over time. And when we talk about this 89.3%, that's the decision to determine what proportion of your money is placed in different types of investments. Different assets like stocks, properties, and savings each have their own return patterns, which essentially means how they behave over time. Stocks or shares have high potential for long-term growth, but are accompanied by short-term volatility. Savings accounts provide security and liquidity, but offer low returns. Properties can offer both rental income and capital growth, but come with high entry costs and maintenance responsibilities. By allocating your resources wisely among the different asset types, you stand a better chance of reaching your financial goals without undue risk. What this all means, according to the Vanguard study, is that simply deciding to allocate your money is 9/10 of the effort needing to find investing success. It's not what you pick or when you do it, just the fact that you are doing it or committing money to that type of investment. What you pick and the platforms you use and all that kind of stuff only accounts for 10%. This slice of the pie covers factors like market timing and individual security selection, aka when you invest and what stocks you pick. While that isn't insignificant, the role is relatively minor in the grand scheme of long-term investing. If you think about what we see advertised, it seems like the products, the stocks, the ETFs, the currency, the products, the tools are the most important part. But here, the research suggests otherwise. It's all noise. Yeah, you might get lucky picking a winning stock or timing the market just right, but these are the cherries on top rather than the main course. The main thing is you've got to be in the game to win. That means if you want your money to grow, you need to be invested in assets that actually grow, like shares or property. If you let your money loiter in savings accounts, then you can only expect low returns. The Vanguard study makes it clear. The specific stocks or properties you're into are kind of like your favorite topping on a pizza. Nice, but not critical. What really matters is that you're eating the pizza in the first place. And in finance terms, you're invested in the right kind of assets. Now that you know how important asset allocation is, how do you actually figure out how to use it? Decide what you're saving for the short term, money you want within the next 10 years, and then decide what you're investing in for the long term, 10 to 25 years plus. Short term, you probably want stability, so pick something more stable like a savings account. If you've got a chunk of cash you won't need for a decade, you can get into growth assets like stocks or property. My site has plenty of articles to help you with that, so go have a look out, links in the description below. But the idea is to look out for opportunities that are better than the low risk, low reward options like a savings account. Products like ETFs are not just easy to start small with, but great transparent investment options. They each have their own product page that explains what type of returns you can expect over certain timeframes. Here's a few practical tips on how to utilize asset allocation. First, know your goals. Understand what you're saving and investing for, and let that guide your asset allocation. Keep it manageable. Diversify, but keep it straightforward enough that you don't need an MBA to understand your own portfolio. Rebalance. Markets change, that'll mess with your asset mix. Adjust periodically to keep things in line. Turn off the noise. Forget about market hype and news. Stick to your plan. Get some guidance as well. If it's overwhelming, consult a financial advisor. They can tailor advice to your unique situation. If you want extra guidance, support, and tutorials on how to do any of this, though, you can always visit my site where I've got articles, tools, courses, coaching, and all that kind of stuff to emphasize the things that really matter when it comes to investing success. The final word on asset allocation is this. Yes, it's a technical term, but if you get a head around how it works, it'll help drive more than 90% of your long-term success as an investor. All it means is moving to a game plan that focuses on stuff that grows, like stocks or real estate. The actual stocks you pick of when you jump in and out of the market, not such a huge deal. Kind of like stressing over the color of your car when you should be more concerned about the engine inside or the route you're going to take. You just got to be in the game. Stashing your cash in a regular old savings account won't help you grow your wealth long-term in a meaningful way. Keep it straightforward. Check in now and then to keep things balanced. And if you're scratching your head, there's always someone you can chat to for guidance. Happy investing.